Welcome back to the Daily Crypto Deep Dive. If you're listening right now, take 2 seconds, hit follow, and drop a 5-star rating. It helps more than you think, and it keeps this podcast visible to people who still want signal, not noise. Today, we're not talking price charts or ETF flows. We're talking about something far darker. Because earlier this week, the U.S. Justice Department announced one of the largest financial seizures in modern history. More than $14 billion worth of Bitcoin tied to a sprawling online scam run out of Cambodia. It's a story that blends greed, human exploitation, blockchain forensics, and global power politics. And it raises one chilling question. If the feds can track down this kind of network, who or what is truly anonymous anymore? Let's start where it all began. Somewhere outside Phnom Penh, past the tourist routes and riverfront cafes, sit entire compounds surrounded by high fences. From above, they look like office parks. Inside, they were prisons, controlled by an organized crime syndicate masquerading as a tech investment group. Thousands of people were trafficked there, forced to run what authorities now call one of the largest pig-butchering fraud networks on Earth. If you're unfamiliar with that term, it's a scam designed to fatten up its victims. The operators contact people online, build fake relationships, introduce them to crypto opportunities, and slowly drain every dollar they can extract. By the time the victims realize what's happened, the money, often millions collectively, has been converted into Bitcoin and bounced through a web of wallets designed to vanish it. Except this time, it didn't vanish. The investigation began when US and UK intelligence noticed identical wallet patterns appearing in fraud cases reported by victims across 3 continents. Addresses were reusing transaction behaviors too consistent to be coincidence. Timing intervals, dust patterns, even transaction fees that suggested automation. Chain analysis firms were brought in, quietly linking the movements together. It took months, but when the pieces finally lined up, they pointed toward an unlikely hub, a Cambodian conglomerate known as Prince Holding Group, controlled by a flashy tycoon named Chen Ji. On paper, Chen ran a web of real estate, media, and investment subsidiaries. In reality, U.S. prosecutors allege that some of those subsidiaries were laundering billions in stolen crypto through exchanges and over-the-counter brokers in Hong Kong, Singapore, and Dubai. By early 2025, Western investigators had traced the Bitcoin across 7,000 wallet addresses, an almost impossible puzzle that relied on sophisticated heuristics, subpoenas to exchanges, and metadata from seized phones inside the scam compounds. Each piece of data fed a neural network model that predicted wallet clustering with over 97% confidence. It was digital detective work at the highest level, slow, methodical, and patient. The breakthrough came when a mid-tier exchange in the Gulf flagged a large inbound transfer from an address already marked high risk. That one alert connected a billion-dollar wallet chain to Chen's corporate accounts. Once they had the bridge, the feds froze it. Within weeks, an international seizure warrant was issued. When agents finally moved, it wasn't a cinematic raid with flashing lights. It was a set of quiet keystrokes. Cold wallets were cloned, private keys were extracted under sealed court order, and by dawn the following morning, $14.1 billion in Bitcoin had been transferred into a government-controlled multi-sig wallet. It was the digital equivalent of hauling away truckloads of cash, only faster, quieter, and cleaner. The announcement came 24 hours later. The press release was clinical, almost sterile. The Department of Justice has seized approximately $14 billion worth of Bitcoin connected to transnational fraud and human trafficking operations. Charges have been filed against Chen and associates for wire fraud, money laundering, and conspiracy. But beneath that cold legal language was a reality that hit the crypto world like a thunderclap. $14 billion isn't just a criminal headline. It's liquidity, leverage, and market psychology. And overnight, that capital was gone. Traders started asking the obvious question, would the government sell it? Because history shows, when seized coins start moving, prices tremble. You remember the Silk Road auctions, the Bitfinex recoveries, even the Mount. Gox trustee movements. Every time, markets react. The difference this time is scale. Analysts estimate the stash represents roughly 1.3% of total Bitcoin in circulation. It's not enough to sink the market on its own, but it's enough to haunt it. Because every time those coins shift, the entire blockchain sees it. Transparency cuts both ways. It builds trust, and it breeds paranoia. But let's go back to the human layer. The DOJ press conference was careful not to show images from the seized compounds, but leaked photos from humanitarian groups told their own story. Rows of makeshift cubicles, computers stacked 3 high, motivational posters written in Mandarin, and armed guards standing near chained doors. These weren't hackers in hoodies. They were victims themselves, many tricked with promises of call center jobs, and then forced to scam strangers overseas under threat of violence. It's the ugly underside of the digital economy, when the same technology that liberates can also enslave. And the irony of it all? Most of the stolen crypto ended up flowing through the same networks that honest traders use every day: Binance, OKX, Huobi, smaller OTC desks in Thailand and Vietnam. Forensics showed that laundering pathways often split large sums into thousands of microtransactions, some under $10, to slip through compliance filters. From there, mixers, privacy chains, and cross-chain bridges obscured the trail. Yet no amount of obfuscation could defeat time. On-chain data never disappears. It only waits to be connected. And that's where this story turns from crime thriller to data-driven inevitability. Because while headlines will praise the seizure as a victory for justice, the real hero is the blockchain itself. Every transaction was permanent. Every movement left a breadcrumb. All it took was patience, computing power, and coordination across borders. But even in victory, the story isn't over. Those billions now sit in digital limbo, frozen, visible, and politically radioactive. The US Treasury must decide what happens next. Do they auction it? Do they hold it as evidence? Do they repurpose it for victim restitution? Each path carries consequences. Sell it, and you risk denting price. Hold it, and you remove billions from circulation indefinitely. Meanwhile, governments around the world are studying the case, taking notes, building their own crypto forensics units. What started as a single fraud investigation has become a proof of concept, a demonstration that state power and blockchain transparency can coexist, at least when they share an enemy. But the bigger question, the one we'll unpack in the next section, is this. What does it mean for the future of crypto privacy? If the world's most sophisticated criminals couldn't stay invisible, can anyone? That question rattled around the crypto space for days after the seizure. On-chain sleuths combed the addresses, trying to trace exactly how Chen's network slipped through compliance cracks for so long. Exchanges scrambled to check if any of the tainted coins had ever brushed their order books. And the privacy crowd, the diehards who built this movement on the idea of financial freedom, were suddenly staring at a new kind of paradox. Transparency as both sword and shield. For years, the myth of anonymity has been crypto's double-edged promise. The freedom to transact without permission, and the fantasy of being unseen. But blockchain doesn't forget. The same ledger that protects ownership also exposes it. It's a diary that never burns, and the DOJ just used it to write a chapter no one expected. Inside law enforcement circles, the mood was celebratory. Analysts called it a landmark victory, the Silk Road moment of the 2020s. Because this wasn't luck, it was infrastructure. The Justice Department had quietly spent years building its digital forensics unit, pairing blockchain analytics with AI pattern recognition and international data sharing agreements. When the Chen case landed, they were ready. In a press briefing that most of crypto Twitter ignored, one DOJ official said, "This wasn't about catching one man. It was about proving that digital crime leaves digital fingerprints. That sentence might end up in textbooks. But in crypto, every victory has an aftershock. The same tools that catch fraud can track ordinary traders. The same subpoenas that unmask crime can pierce privacy. Governments now know that on-chain data is a goldmine, not just for justice, but for policy, taxation, and surveillance. And that's the uncomfortable part of this story. Because while the industry applauded the takedown, it also felt the chill of what it implies: total traceability. Analysts say we're entering the age of regulatory on-chain visibility. It's the idea that blockchain's openness will eventually merge with global compliance networks. Exchanges are already halfway there. Banks, custody providers, even DeFi aggregators are plugging into compliance APIs that flag suspicious flows in real time. The Chen case gave regulators the political ammunition they needed to push that integration faster. For ordinary investors, that means the dream of true anonymity is fading. But it also means safety. Fewer rug pulls, fewer scams, fewer overnight implosions. It's the inevitable compromise between freedom and protection. And as that debate raged online, the markets reacted the way they always do. First with fear, then fascination. Bitcoin dipped on the news, recovered, then dipped again when traders realized the seizure might eventually translate into future supply. You could see it in the funding rates. They flipped negative overnight. Yet amid the red, something curious happened. The long-term holders didn't move. The whales stayed still. The number of addresses holding at least one full Bitcoin barely changed. It was as if the smart money understood what everyone else forgot. That seizures and shocks don't break the chain, they validate it. The ledger worked exactly as designed. Let's pause there for a quick word, and a reminder that ties directly to this story. If this week taught us anything, it's that control of your own keys is everything. Exchanges freeze, governments seize, hackers exploit. But a cold wallet can't be hacked remotely or seized without you. So if you haven't already, protect your crypto with a hardware wallet. We use Ledger, the link's in the description below. Security isn't optional, it's survival. Back to the story. Within days of the announcement, international agencies began tracing the network's human side. The workers trapped inside the scam compounds. Some were rescued, others vanished into bureaucracy. The Cambodian government, under global pressure, launched a task force. Human rights groups flooded the region, documenting the overlap between trafficking and tech crime. It's one of those moments when you realize crypto isn't just finance anymore. It's geography, politics, and morality colliding in real time. Meanwhile, blockchain analysts continued digging. They discovered that Chen's operation used at least 7 different privacy layers, including mixers, cross-chain bridges, and NFT wash trading to recycle stolen funds. The pattern was almost elegant in its cruelty. Automated scripts that converted Bitcoin to stablecoins, then to obscure tokens, then back to Bitcoin again, generating noise designed to drown the signal. But even that couldn't erase the math. Because every mixer, every bridge, every exchange ultimately has endpoints, where people interact with fiat, where KYC meets the real world. And those endpoints are where the system breaks. No matter how many proxy wallets or synthetic addresses exist, sooner or later, money meets identity. That's how they caught them. Not with Hollywood hacking, not with spies in trench coats, but with the slow inevitability of transparency. As one blockchain forensics expert put it this week, in crypto, the only privacy that works is the one you never need to hide. That line stuck with me, because it reframes the entire discussion. Crypto was born to be open, code, ledger, access. It was the old financial system that thrived in secrecy. Maybe the endgame isn't hiding from the system, but forcing the system to play fair in public. Of course, that's not how everyone sees it. Privacy advocates warn that celebrating seizures like this sets a dangerous precedent. They argue that mass surveillance tools don't distinguish between good and bad actors. They fear a world where regulators can freeze any wallet at will. It's a valid fear. But here's the reality. The train has already left the station. The DOJ just showed every government on Earth that crypto is traceable. And once power sees a tool that effective, it never goes back in the box. So where does that leave us? Somewhere in the middle. The Chen seizure marks both a moral victory and a moral hazard. It protects victims, but it empowers governments. It purges bad actors, but it chips away at the myth of digital invisibility. It's the paradox that defines this entire era. Security through exposure. For investors, the takeaway is simple. Regulation isn't coming. It's here. Privacy coins will face harder scrutiny. KYC will expand. But mainstream adoption will accelerate too. Because now governments know they can trace, they're less afraid to participate. It's ironic, but the road to legitimacy often runs straight through enforcement. For traders, that means fewer black swans and more policy shocks. For builders, it means designing with compliance baked in. And for everyone else, it means learning to live in a transparent world without losing the values that made this space special in the first place. When I think about the Chen seizure, I keep coming back to one visual. A cold wallet, silent on a blockchain, glowing like a beacon among billions of transactions. Somewhere, behind that address, a human being believed they were untouchable. And yet here we are, watching the same coins sit frozen, publicly visible, owned by the very system they tried to exploit. That's the paradox of crypto. It exposes you even as it empowers you. Maybe that's the lesson the entire industry needs right now. That freedom without accountability collapses under its own weight. And that transparency, uncomfortable as it feels, might be the thing that saves it. If you've made it this far, you're the kind of listener who sees beyond the headlines. So do me one favor. Follow the show, rate it 5 stars, and share this episode with someone who still thinks crypto is just numbers on a screen. Because stories like this, stories of billions lost and found, are shaping the very foundation of what digital value means. Crypto isn't disappearing after this. It's maturing, painfully, publicly, and inevitably. This has been your daily crypto deep dive. We'll be back tomorrow with new stories, new numbers, and new lessons from the frontier of finance. And as always, we'll see you at the top.